Preparation of final accounts, financial statements. Trial balance. We are already aware that trial balance is only a list of balances of ledger accounts, including cash and bank balances. Besides, there are a few adjustments which also need to be considered before preparing the final accounts. These adjustments typically occur at the end of each accounting period. They may be due to some revenue and expense items that may relate to more than one accounting period, or some revenue and expense items have been earned or incurred in a given period but not yet entered into the accounts, commonly called accruals. These would be dealt at a greater length subsequently. Trading account calculates the gross profit. It takes the direct cost of production away from the sales revenue. Hence, it is necessary to include all items of expenses directly affecting the cost of goods sold. The cost of goods sold includes the purchase price of goods sold plus procuring expenses and the expenses of conversion of raw materials into saleable finished goods. The debit side of a trading account contains account heads like opening stock, net purchases, carriage inwards, cartage, dock charges, wages, duty, freight, clearing charges. The credit side of a trading account contains account heads like net sales and closing stock. Against this, the profit and loss account takes the expenses, indirect costs away from the gross profit to calculate the net profit. There are many other expenses to be incurred for operating the business. Therefore, profit and loss account is prepared to consider other operating expenses in order to ascertain net profit or net loss. The debit side of a profit and loss account contains account heads like salaries, rent, rent and rates, discount allowed, commission allowed, insurance, bank charges, legal charges, repairs, advertising, trade expenses, office expenses, bad debts, traveling expenses. The credit side of a profit and loss account contains heads like interest received, discount received, commission received, other receipts. Let us carry out the analysis of the given trial balance for a better understanding. From the given trial balance, revenue items form a part of the trading and profit and loss account. The capital items help in the preparation of a balance sheet. First of all, let us try to analyze each of the debit balances as either an asset or an expense or loss. Bank asset, cash asset, opening stock expense, conveyance expense, purchases expense, salary expense, wages expense, transportation expense, commission expense, rent expense, debtors asset. Next, we shall try to analyze each of the credit balances as either an equity or liability or revenue or gain. Sales revenue, creditors liability, capital account equity. One more aspect, the preparation of trading and profit and loss account requires that the balances of accounts of all concerned items are transferred to it for its compilation. In this case, this is achieved by recording the following entry. Trading account debit 95,200 rupees. To opening stock account 50,000 rupees. To purchases account 37,000 rupees. To wages account 6,000 rupees. To transportation account 1,200 rupees. Next, purchase returns account needs to be transferred to purchase account by passing the entry. This is because purchase returns results in reduction in the total amount of purchases. This is achieved by passing the following entry. Purchases return account debit 3,000 rupees. To purchases account 3,000 rupees. Next, the sales account is closed by transferring its balance to the credit side of the trading and profit and loss account by recording the following entry. Sales account debit 1 lakh rupees to trading account 1 lakh rupees. Closing stock does not normally form part of trial balance. It is brought in the books with the help of the following journal entry. Closing stock account debit 40,000 rupees to trading account 40,000 rupees. Next, other indirect expenses and incomes are transferred to the profit and loss account. In the given example, the entry to be passed would be profit and loss account debit 38,500 rupees. To conveyance account 2,500 rupees. To salary account 31,000 rupees. To commission account 2,000 rupees. To rent account 3,000 rupees. In the given example, gross profit arrived at after deducting the trading expenses is 45,800 rupees. The profit and loss account is opened with a gross profit transferred from the trading account or with gross loss which will be debited to profit and loss account. After this, all expenses and losses which have not been dealt in the trading account are transferred to the debit side of the profit and loss account. If there are any incomes or gains, these will be credited to the profit and loss account. The excess of the gain over the losses is called the net profit, and that of the loss over the gain is called the net loss. The account is closed by transferring the net profit or loss to capital account of the partners in their profit sharing ratio. In the given example, net profit arrived at is 7,300 rupees, which is to be transferred to the partners' capital account in their profit sharing ratio. A balance sheet is a statement drawn up at the end of each trading period. It takes into account all the assets and liabilities of a business arranged in the customary order to exhibit the true and correct state of affairs of the firm as on a given date. A balance sheet is prepared from a trial balance after the net profit or net loss has been transferred to capital account. The remaining balances of personal or real accounts represent either assets or liabilities as at the closing date. These assets and liabilities are shown in the balance sheet in a classified form. The assets being shown on the right side and the liabilities on the left-hand side. Grouping and marshalling. In a balance sheet, assets and liabilities should be properly grouped and classified under appropriate headings. The groupings together of dissimilar assets will make the balance sheet misleading. The term marshalling means the order in which assets and liabilities are stated on the balance sheet. This is due to the fact that the balance sheet exhibits the financial position of a concern even to a non-technical observer. The balance sheet is generally marshaled in two ways: the order of liquidity or realizability. First, the order of liquidity or realizability. Second, the order of permanence. According to the first method, assets are entered in the balance sheet following the order in which they can be converted into cash, and the liabilities in the order in which they can be paid off. The following is a format of a balance sheet based on this order. According to the second method, the assets are stated according to their permanency. That is, permanent assets are shown first and the less permanent are shown one after another. Similarly, the fixed liabilities are stated first and the floating liabilities follow. This is a specimen of a balance sheet based on this order. Let us try to prepare a balance sheet on the basis of the given trial balance. Net profit or net loss so computed is transferred to the capital account in the balance sheet by way of the following entry. 1. For transfer of net profit, profit and loss account debit to capital account. 2. For transfer of net loss, capital account debit to profit and loss account. In the given example, the journal entry would be profit and loss account debit 7,300 rupees to capital account 7,300 rupees. Thus, we can see that the balance sheet must follow this formula. Assets is equal to liabilities plus shareholders' equity.